You can't change what's already happened. And I don't mean over the last 4 years, I'm talking about the last multiple decades of constant increase in the power of the central bank to distort money, other government spending and so forth, which is now at crisis levels. Trump's walked into it. And, hopefully he can explain ahead of time that, I didn't cause this. This is a reality that was already there. But it's going to be a dark reality.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for December 30th, 2024 through January 6th, 2025 while supplies last. This week we feature 2024 1-ounce silver eagles at just $4.85 over spot, one of the lowest premiums we've seen in years. We have a limited supply, so these are first come, first serve. Next, 2024 1/10-ounce gold eagles are just $44.99 over melt per coin. We also have an incredible deal on XF $20 gold Liberty coins at just $75 over melt, one of the lowest premiums on pre-33 gold we've seen in a long time. And finally, 1/10-ounce Gold Britannia are just $29.99 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
Good to be back, Elijah.
Well, it's great to have you today. I did want to get first maybe into the stock market. We can show the charts here that you shared with me pre-interview on the screen here. It seems like there might be some weakening happening in the stock market here. I did also maybe just want to point out that I've also been hearing that kind of on the fundamental side, a lot of insiders are selling. Warren Buffett having his largest cash position ever. So where do you think the stock market is right now?
Well, I think it's topping, and I think it's probably topped. The question, though, is when do you break the bridge underneath your feet and collapse, okay? And when you look at the price chart, again, the charts I sent you, one is the top chart is a simple weekly price chart of NASDAQ 100. And the reason we pick it, of course, is it's the leader index. It better than doubled what the S&P did since the 2009 bear low. Over the last 15 years, it's gone up far more than double. And we all know that most of the leader symbols that everybody likes to talk about and focus on, they're embedded in the front end of the NASDAQ 100 with very heavy weighting, such that you can basically take the NASDAQ 100 and take the last 95 stocks and throw them away, okay? And just look at the top 5 or so because of the weighting. Same is true with the S&P, but a little less emphasis on the weighting of those same symbols. But they're still front-end weighted indexes supposedly reflecting the U.S. stock market. And we know that's not really true because there's some sectors that are not doing as well as the S&P and NASDAQ and are extremely vulnerable, just like the S&P and NASDAQ. And for instance, the small caps basically double topped recently at their 2021, late 2021 price highs. So the small caps only came back up to the prior peaks. But anyway, what I wanted to show is the two views of reality. And the one that's the most popular is, of course, the price chart. And it's, if you try to draw a multi-point uptrend going back to the 2022 price lows, that would be in October of 2022. So it's been 2 years plus. And try to draw a line that connects more than 2 lows, like 3 or 4 lows in a row, all lined up perfectly to draw a valid trend line. You can't do it. If you draw a line through those first 2 lows, it just goes off into space. You're nowhere near it. You more or less have an upward curvature. And so when you look at the price chart, you think, wow, it's fantastic. There's nothing here. I got to go a long way down to break anything, But when you look at our momentum chart, you see a totally different picture. Yeah, if you look at that top chart again, you'll see it's just upward curvature. And if you go back to that October 2022 low, just above 10,000, and try to draw a line that connects more than 2 lows, trend lines aren't valid unless they at least connect 3 lows, okay, to define a line, and you break it on the 4th effort. Any 2-point trend line is basically invalid even on a price chart. But anyway, you don't have anything nearby that's you can break. The last major pivotal low you could see was last summer. In August, we dropped down under the 18,000 level on price. It came up. So if you want to use that as your stop out point, well, you're going to give up 4,000 points from the high before you even acknowledge that, this market's in trouble. But now if you scroll down to the bottom chart, that shows what this shows is each week we plot the closing price of the NASDAQ 100 in its percent relationship to the 3/4 moving average. Now that's a long-term moving average. The 200-day average shifts every single day, little micro shifts up or down. 3/4 average, though, is about the same duration of time, but it only shifts once every quarter. It goes up, follows the market underneath, or if you're in a bear trend, it'll be above the market usually. In this case, you can see that it was since the 2022 low, we went from 25, 26% below that average and shot up to a peak reading in 2023. It was about 28, 29% over. And then we went into this, we dropped, and then we went into a more or less sideways range, while of course price continued to go higher. But when we plot it in relation to the 3/4 average, each weekly close as a percent, how much percent above or below, we have the black line. When the black line connects 1, 2, 3, 4 pivotal lows, almost 5, and you'll see that the current reading, by the way, which is I did just before this report, where the NASDAQ was at that point in time, which is not the close yet, is hard down and right in front of that black line. Or as you drop another percent or so, you could blow that structure, okay? And if that were a price chart, you'd say, oh my goodness, I got to get out of here, But there's another line we've got here that's quite interesting. It's a little red horizontal line there. And it goes back to the beginning of last year. And there was a low in April, and there was a low in early August, and there's a low in late August. So all three of those pullback lows that define that red horizontal were 5.1 to 5.2% above the 3/4 average at that point in time. No, the price wasn't making the same horizontal low, but momentum was stopping exactly just above the plus 5% level. Never had a weekly close below that red line in the last year or so. If you close a week at 5% over the current 3/4 average, you will blow not only the black line, but you'll blow that red horizontal, which is almost perfect to the decimal. And that level is just barely below the low trade we've seen in the recent drop. Down under 21,000, around 20,700 zone. We were very specific in our reports. So we're dancing above the structure. Do you feel lucky that this bridge that's been banged on for so long and created such clarity of structure, you think it's going to hold again? We don't. There's other metrics of similar time scale and lesser time scale that have already broken. And many of the subsectors within the stock market, when you run similar studies of them, they've already broken. So I think we're literally a rat's hair above the level that will blow the bottom out of this market. And whenever we find a structure that's so clear, the momentum structure, so many hits on it, the ripe, we call that ripe, okay? Whenever you see a structure that's that ripe, it's intended for use, not some future date down the road, but it's now so ripe it's ready for use. We suspect it will be used this quarter and quite probably in the next few weeks. Once you break it, we declare we're in a major bear trend.
That's quite concerning. I know that we had Francis Hunt on, and he was saying very similar things about timing just in the next couple of weeks. There are many indicators showing that we could see a major breakage and crisis here. He was talking about the bond market, the yield curve inversion really uninverting now here. I guess looking on a fundamental view, I mean, as I mentioned at the beginning, we are seeing insiders kind of reacting to this, largely getting out of the stock market. What is your take on some of the fundamentals we're seeing that might also be signaling that this could all be coming to a head soon?
Well, we've had what we call, people like to talk about prior stock market bubbles. The 2007 high was a bubble. It was mortgage defaults and all that stuff. And then 2000 high was the dot-com bubble. And in 1929, of course, everybody thinks that was a bubble, and we collapsed to 1932, wiped the thing off the page almost, percent-wise. And it took decades to get back to it. So those are things people call bubbles. But this bull market bubble that we've had since the 2009 low has been created by factors that are so bleeding obvious that when you go to the Federal Reserve of St. Louis and click through some charts, and I suggest looking at M2, for example, the money supply, and looking especially at the Fed funds rate chart, you'll see that we've had interest rates by the Fed, the short end of the market, near zero for 15 out of the last 15 years. About 10 of those 15 years we were at zero. Money was free. And even when they raised it recently, and now it's starting to back off again, even those levels are historically very low levels. If you go back 50 years on that M2 chart, you'll see even though they raised rates recently, they're still very, very artificially low cost of money. When you have that sort of embedded error, fundamental macroeconomic error being the pricing of money, most essential commodity in any transaction throughout the world or domestically, it's the most essential commodity, because when I buy from Mr. A to buy a product and he gets the money and I get the product, he wants to be sure that what I give him is actually got a whole value between now and next year, and and so forth. And if it's changing in value because of the quantity of money increasing drastically, in the last 15 years we've had more money growth than we've had in any other 15-year period, percent-wise, decay in the real value of the money. And then we've had artificially low rates. So that creates errors, individual micro errors, family errors, corporate errors. And they're protracted over a very long period of time. We're not talking about a 2-3 year bull market that's busting. We're talking about a 15-year bull market that went up like 5 times more percent-wise than any prior bull market. And you can say, whoa, it's a good, strong economy. Yeah, right. It's due to look at the M2 chart. We've been drug infused with M2 money growth and with free money, effectively, for so many years that it's as if we've been administered hallucinogens by the central bank. And so when those errors start to get ripped open and exposed to the wound, and you start to hemorrhage, then it's beyond the control of the central bank at that point to then sort of, oh, we made a mistake. Let's go back and fix it. They always try to. You go back and look at the 2000.com top. They started cutting rates in early 2001 dramatically. All the way down, the market collapsed. Nasdaq went down 82%. Rate cuts didn't save it. 2007 mortgage peak, we collapsed 50%. In S&P, they cut rates all the way down. It didn't stop it from collapsing. So this time around, even though they're going to cut rates, they've already started, once the stock market peaks, that's historically when you see the data points, the things like they like to talk about. What's unemployment look like? It's factory output. All those metrics that the Fed likes to look at will suddenly go dark. Not before the market breaks, but after it breaks. That's when it occurs. And at that point, the central bank, not just ours, but others, will go into panic mode in unison. They work together. And that will create monetary expansion globally, not just here. And desperation and moves by central banks to buoy their assets they deem worth buoying, like the stock market. The beneficiary of that's going to be primarily the monetary metals. And that's the place to be, especially this coming year. And we've been waiting at MSA for the breakage of the stock market as a key factor in causing the monetary metals to go into the more berserk mode on the upside. Because once that blood starts to come out of that market, it goes somewhere else. Anytime the stock market collapses, the asset flow doesn't disappear. It actually seeks other places. Usually that's T-bonds and gold. This time around, it's going to be primarily gold and related markets. And it's the breakage of the stock market that is the key pending impetus for gold.
Now, can you expand a bit more on what you see in the gold market right now? And also, I know your latest report was about gold and silver versus commodities. So what kind of signals are you seeing there?
Well, Over the last 25 years, we showed a chart going back to 2000 where Bloomberg Commodity Index and the gold were measured against each other. And gold is now back at basically its all-time highs of the last 25 years. There was a period there when gold had doubled in price between its 2015 low and the mid-2020 summer of 2020 high. Went from 1,050 to 2,070, almost doubled. During that same time, Bloomberg Commodity Index was still going down. Commodities were not following gold. And then when gold paused for a couple of years there, it frustrated everyone, went into a range that was at max 20% wide, but most of it was about 15% wide. Bloomberg exploded. So the Bloomberg versus gold spread collapsed versus gold. So gold underperformed during that period from about 2022 to early 2024. Now has exploded back up again, back to its all-time highs, gold versus commodities. But it's our technical assessment and fundamental assessment that the commodity complex will be a place that exiting money from the stock market will be going. And I don't mean going into corn futures and oil futures, but into stocks related to those commodity markets, like oil-related stocks, base metal-related stocks, agricultural-related stocks like fertilizer and so forth. There will be a place to go. So if you're looking for an alternative place within the stock market, I would be looking at commodity-related sectors, and particularly, I think, ag sectors, agricultural-related, would be a best place. Then there's the issue of the gold miners, the dogs, gold and silver miners. If you go back, we ran a chart a few weeks ago showing the XAU index, which is the Philadelphia Gold and Silver Miners Index. It says miners. And it traces back to 1986, that index. So it's also not an ETF. It's not traded as such, like GDX is. But if you measure that index from its bare low in 2015, coincident with when gold made its low, it's gone up like 120% at current price levels. It's actually, since the S&P, it beats the S&P, but nobody notices this marginally, but it beats the S&P over the same span of time. And yet it's hard to believe that, but you can actually measure it. But when you look at the long-term charts of the gold mining sector, the price charts, but especially when you look at its valuation versus gold, the miners, how cheap are they versus an ounce of gold? Or how expensive are they? Right now, they're on the floor. Okay. And they've been there since 2015. Not been losing ground. The miners have held their ground since 2015 on a percentage basis. They've gone up about as much as gold, if a little more. But they'll accelerate to the upside at some point. And that point will be, especially when people in the stock market say, hey, I got to get out of this thing. I need to buy some other kind of stocks. They're not going to go out and buy gold, silver futures and use leverage, and they're probably not going to use double long ETFs of bullion. They're going to go for the gold miners and silver miners. And since that's such a tiny little sector, and it's so undervalued, not only in relation to gold, but in relation to the S&P, it won't take much money flow, the blood flowing out of the stock market into some other category, to boost the gold miners off the page, because they're such a tiny little asset category. And we expect to see that in 2025, where suddenly the perception that miners are dogs that, lag gold all the time, and they don't. Sometimes they actually lead. People overlook that. But they'll go into a leadership position, and I think that's probably going to be the best place to be on the planet, is in gold and silver miners in 2025.
So that's very interesting. And I know one of the things that you've said over and over is that this time when the stock market has a major crisis here, that metals will not fall along with the stock market at that time, which is what we've seen in the previous, maybe a few times that we've seen stock market sell off. So can you maybe get into this again? Why do you see metals will really be the beneficiary of this crisis?
Because they're monetary, they're money. But even raw commodities like copper, let's say, an industrial metal, looks poised to go up while the stock market goes down. If you go back and look at the late 70s, we had stagflation. Economists couldn't figure it out. How can you have inflation and yet collapsing, a wasteland in the stock market for a decade almost? And yet commodities exploded all during that time, the 77, 78, 79, and 1980. They went up with gold, not as much, but they went up strongly. And yet we're in a global recession. So the examples that people remember and are burned in their memories are very isolated instances where gold temporarily had a bad month along with the stock market. Before I founded MSA in 1992, and we only had institutional clients at that point, I caught the crash in 87. I didn't catch it in a big way. I caught it in a small way, but I did it with puts. So I got my customers in it as well. I was a futures broker. And I learned a lesson. But during that collapse, and gold wasn't even in a dynamic market at that time. It wasn't, you wouldn't define it as a super strong bull market. But the stock market collapsed, gold went up 10% that week. Same week that stocks went down 30-something% and went up 10, okay? So, but you go back to the 2008, 7-8 bear market. In October of 2008, there was a crash type event in the stock market, but it was a full year off its high. It had already been in a bear trend since September, October of 2007. So in October of 2008, way off the price high, a lot of time off the high, it had a 30% collapse month. It takes that dimension for it to be labeled crash, 30 plus in a couple of weeks. And gold at that point had been rising sharply in that period of time, but suddenly in August, September, and especially October, gold had a relapse. It needed to have a correction. It was technically ripe to have one, but it lasted basically 1 month where it was doing the same thing as the stock market. And then the stock market continued down until March of 2009. Gold was back at its highs by then. People ignore that. So yes, there was a 1 month phenomenon. Also, COVID event was another time. But they're isolated events and they're not part of major trends. They're hiccups. And yet people seem to have that only in their mind, not the major trends. And if you go back and look 2000 to 2002, major bear market, dot-com collapse, gold was up all during those years. Okay? And from 2000 to 2011, gold had a massive up move had an interruption in October 2008. But during that same period of time, the stock market was not performing well. It was in a lateral position since its 2000 high. In fact, it took it, after the 2000 peak, it took the S&P 13 years to finally go up and exceed it and move on up. It was until 2013. For the NASDAQ 100, after it peaked in the year 2000, it collapsed, and it was 16 years before it could ever get back to the price high that it had seen in 2000. So if you factor in, if you didn't get out in 2000, and by the way, MSA put out a major sell signal in January. Yeah, it took it about a year to collapse, but it finally did. But it took it 16 years. Imagine not having gotten out and not gotten long gold during that time. Gold was very cheap then, year 2000. It went up through 2011. It took you 16 years to nominally get back to the price high you saw in 2000. I say nominal because the degradation of money over that 15 years, the real buying power, collapsed big because, the money supply almost doubles every decade. So you've got to keep that in context. A lot of people are too focused on one minor event here and one there. They isolate and they don't see the real context.
It is interesting, as you mentioned, to really consider the risk here as well. I mean, people maybe are looking at, a lot of people say, well, on average, the stock market goes up, 8% a year or whatever. But really, if depending on the time frame you're looking at and when you get in, it can be real risky. And you may not make back your money for quite a while.
Yeah, my son Brett did a major report on that a few weeks ago on long-term investing assumptions, and it went back 100 years, to the 20s. And the number of times you've had those debacles where not only do you get a bear market, it might be over in a couple of years in terms of the high to the low, but in terms of really getting back to where you were, you wasted decades, sometimes a decade and a half. So from an investment point of view, in other words, a guy who's a long-term quote investor, if there's any such people around anymore, that's too much time to waste. That's half of a human investment lifetime, almost 15 years. So you can't afford to not get out of the way when those events occur. And we're arguing now that one of those events is about to occur, only this time it'll be worse. Why? Because the nature of the bubble is multiples, time-wise and dimension-wise, much more error built into it than the prior bubbles that we like to look back at. And therefore, the real-world consequences, not just to stock market asset holders. But think of it another way. Right now, most average Americans, let's say upper middle class on down, are not real pleased with their day-to-day cost of living, mortgage rates, et cetera. You can see it in the high credit card debt. It's the highest ever, and the delinquencies. Also delinquencies in tax payments, things like that. They're hurting. There's only one arena in which they can look at a TV screen and smile. And that's their retirement account. If they're matching the S&P or the NASDAQ, boy, they've had a great couple years here. From a bad 2022, they took it till 2024 to get back to the high, but then they had a nice year in 2024. And they're smiling. It's the only place they're smiling. What happens when that goes away? When suddenly, boom, 20% off the top or 30% off the top, in a matter of months. So good couple years and gone in a couple of months. Then there's no way to smile. That's when emotion comes into this equation about the real world consequences. When emotion enters, panic sets in. The data points head south. Unemployment starts to rise. And so suddenly you go from false, happy smiling to frowns. And I think we're on the edge of that right now.
If our viewers are interested in tracking this with you, they can go to olivermsa.com. Can you tell us what they'll find there and any last thoughts you had?
Well, you can request some samples, but we cover all four major asset categories because, especially in this day and age, they interlock either negatively or coincidentally in the same direction. Right now, basically negatively, the stock market, I think, is definitely going to show itself to be inverse to gold. And the T-bonds right now are not providing an alternative, which sometimes they do. The question is, will there be a spark of a rally in that market to help, a place for people to run to briefly? It's not going to sustain, but we think there could be a sharp rally in the bonds or a drop in yields. But right now, the T-bonds are choking the world, choking the U.S. Long-term end of the debt market is not reflective whatsoever of Fed cutting rates. It's at stranglehold levels, and it's been staying there for over 2 years now. And every year it stays there at those high levels, the yield levels. It's choking. And so anyway, we have a crisis ahead, and I don't care who's president and even his intentions, sincere intentions to change things. You can't change what's already happened. And I don't mean over the last 4 years. I'm talking the last multiple decades of constant increase in the power of the central bank to distort money, other government spending and so forth, which is now at crisis levels. Trump's walked into it. And, hopefully he can explain ahead of time that, I didn't cause this. This is a reality that was already there. But it's going to be a dark reality.
Well, Michael, we really appreciate your time today, helping us be aware and prepared. That's always helpful for our viewers. Thank you so much, and God bless.
Thank you, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for December 30th, 2024 through January 6th, 2025 while supplies last. This week we feature 2024 1-ounce silver eagles at just $4.85 over spot, one of the lowest premiums we've seen in years. We have a limited supply, so these are first come, first serve. Next, 2024 1/10-ounce gold eagles are just $44.99 over melt per coin. We also have an incredible deal on XF $20 gold Liberty coins at just $75 over melt, one of the lowest premiums on pre-33 gold we've seen in a long time. And finally, 1/10-ounce Gold Britannia are just $29.99 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.